Hello, hello, hello. Welcome to Al Stock Trade. So, in this video, we're going to go ahead and talk about an important concept that I believe we have not covered yet on the channel. We've basically spoken about it, but I haven't given you an image to be able to seal the deal. So, within our mastering course, we're just going to go ahead and just talk about this here. And for all of our members, you can click down at the federal funds effective rate in our recession predictor model. Now, what I want to show you here, guys, is this is not a live photo. The live interactive tool is actually here. This is just a broken down diagram, which I really enjoy because it actually brings home the concept of what I'm about to explain to you in this relationship and regarding the relationship between the stock market and the federal funds rate. Okay. So for all of our members, you can go ahead and read down here, but essentially we actually broke this down into 4 stages. I think it's easier for people to see. It's an upside down parabola. The Federal Reserve usually starts with rising interest rates, then decreasing the rate of the rise of the increase, right? And then stopping and holding the rates. So it's kind of like your peak, and then decreasing the federal funds rate, which is basically decreasing the rate hikes. So in this diagram, I want you to pay attention to 2 columns. We are not going to talk about the 3-month versus 10-year. It's like the 10-year minus the federal funds rate, or technically the 10-year minus the 2, in this case, the 10-year minus the 3. We're not talking about that. I want us to basically focus on the difference between the S&P 500 and the federal funds rate, okay? So we're going to make this very basic, and we're going to try to explain it because there's a lot of connections and a lot of things that you have to understand as an investor to basically understand what most people and what hedge funds are thinking, okay? So in this diagram, on the top part, I want you to focus on the dot-com bubble crash, the 2000 dot-com crash, and the 2008 great financial crisis, as both of these dropped a greater than 50% decline. Then I want you to sneak all the way down here, and I want you to focus on the bottom federal funds rate. Again, we're not talking about the middle column. We're going to talk about, or the middle row. We're going to talk about the bottom row. So what you're basically seeing here is that every time, again, this is the Federal Reserve, we do rate hikes. Technically, the rate hikes don't really cause the market to crash. The market crashes whenever the Federal Reserve goes ahead and starts dropping interest rates. Whenever you have a drop in interest rates and the Federal Reserve is basically cutting interest rates, that's when you start getting the crash. Again, this stops in 2019. Okay. So again, this is not showing 2020, 2021, 2022. Again, this is part of the course here. I wanted to basically explain to folks kind of how this works here. And I wanted to share it with the YouTube community here. Okay. So as you can see, again, 2008, they raised interest rates. A lot of folks, sadly, retail didn't really care, right? You could have literally seen the writing behind the wall. Interest rates basically started to hold. So stage 1, stage 2, stage 3, and then stage 4, they started dropping interest rates and cutting, and then you had your decline. Again, I don't have the image in here, but same thing with COVID. In fact, we can zoom in here. So this is 2019 and 2020. We can zoom in and just call it how we see it. So this gray bar is a recession. Shaded areas indicate a recession. Whenever the Federal Reserve started decreasing interest rates, that's when we got the recession. Okay, so let's go ahead and refresh the page. Now let's go back down here. Again, whenever we get a decrease, it's usually indicative of a recession. Whenever we get a decrease, we get a recession. The ones that I'm focusing on here is the dot-com bubble crash and the 2008 great financial crisis. And what you're seeing here is basically what you see up top here. Dot-com recession. So if you apply this model, many folks are saying, well, the recession hasn't even started yet because the federal funds rate, technically, if you can go ahead and zoom out, reload the page, the federal funds rate, which is here, again, this is the most recent one in January 2023, is elevated and we haven't dropped yet. And usually when we drop, it's indicative that there is a problem in the economic form. So people are on this camp saying, I don't know what is it going to push, but essentially we're not there yet. Other people are saying, Well, technically, we did drop over 20% in 2022, and that was technically a period of rising interest rates. Rising interest rates, because usually when interest rates rise, the stock market from these two contexts rise as well. But in 2022, when interest rates were rising, stocks were actually dropping. So you have people on another camp saying the market is becoming more efficient. As you can see, it took multiple years for the dot-com bubble crash to basically go ahead and return back to normal, right? Recover essentially the losses. So many folks are saying, well, since the market is becoming more efficient, well, then perhaps maybe the the worst is over. We've already dropped, because why would we drop when the interest rates rise based off of these patterns? So that's the $1 million question. And if you look at smart money and dumb money, which you can basically see here, smart money is not even interested in the market right now. They're about to recover a little bit, it seems like, but dumb money has been basically taking the lead. The question here is, are they going to FOMO? And, people on the All In podcast think that they might. So that's basically, I wanted to explain this relationship between the S&P 500 and the federal funds rate. I just wanted to break it down, like explaining it to a fifth grader. Okay. All right. So let me go ahead. So we're going to go ahead and talk. Bob, comment on a Clover video. We want to keep this just strictly on this relationship, because we don't want to lose people and lose focus. Okay. All right. I'll see you on the next one, guys.